If you need some help learning how to be patient with your stocks, then this video is for you. Hello everyone, my name is Michael Lamott. I am the founder of ChartYourTrade.com, and our goal is to inspire millions of hardworking people just like you to take advantage of the stock market. And today we're going to answer some of Ryan's questions. Ryan wrote to us asking, he had just sold Melly before it took off, Mercado Libre. He tightened up his stop too quickly. He did the same thing with Intuitive Surgical. Now, both of these are stocks within our model portfolio. Ryan is a member of our Advanced Stock Report service. He mentions that he was up several $1,000s. Congratulations, Ryan. That's really awesome. Great job. And that he was very proud of this accomplishment. He couldn't bear to see his gain turn into a loss. He's not complaining, but he missed the bigger intermediate term upside. Mercado Libre broke out of about a 7-month consolidation, and Intuitive Surgical is one that we got back into the middle of 2017. Do I have any tips for dealing with these kinds of fears and having a better overall mindset for being patient with trades? As a matter of fact, Ryan, I do, and we are going to go through 7 of them right here, right now. There's something real important that I want to point out before we jump into these 7 strategies that I have for Ryan. And the thing that I want to point out is that it doesn't matter if you subscribe to somebody's service, if you subscribe to our Advanced Stock Reports or anybody else. Everyone, including myself, are all in our own driver's seat of managing our own portfolio. It's all up to us to click that button to buy, to sell, and to come up with strategies or to follow other strategies that are all laid out for us. The more responsibility that we're all able to take for ourselves, and that can be too, to follow somebody else's trades, trade for trade, the bottom line is that we are all in our own driver's seat, and just because you might be somebody that does your own research or you're somebody that subscribes to a service, the onus is always going to be on us. And if we take responsibility for everything that happens to us in the market, it's extremely empowering. So with that in mind, let's dive in. All right, tip number 1, position sizing matters. Now, I don't know exactly how big or how small of a position you had. It sounds like the position that you were dealing with, Ryan, was pretty large. I would be curious to know what size of your portfolio these positions were. What was your position sizing strategy? Do you have... Do you divide your portfolio up into separate tranches so that way, like let's say if you have a $100,000 portfolio, are you allocating $10,000 to each of them? Are you allocating more? Are you allocating less? Do you like to use a 1% of capital rule and back into the position? That's kind of like what I do, where I'll figure out where I'm going to get in, where I'm going to get out, and then back into the number of shares that I could buy given that amount of risk. So I'm real curious to know how big your position was. Position sizing matters a lot. If we don't have the right position size, then we could be risking way too much and we could risk blowing up. If we risk too little, then our stock could make a huge run and it could be relatively meaningless. We want to have the correct position size, and we want to have a position size too that we're going to be comfortable with. If the position is too large, then we'll end up mismanaging the trade. So we want to make sure that we're risking the right amount to not blow up our account, and we also want to make sure that we're risking the right amount where our mental capital is not at risk. That's something that's going to be different for everybody. I like to risk 1% of my capital and back into the number of shares. And for me, that's closely aligned with what I'm comfortable with mentally as well. Tip number 2, scaling out of positions. Now, this is something that I spoke about recently in that BlackBerry video. I'll link it somewhere up here. I always like to scale out of position. So as a stock is making progress, and particularly in my swing trading account, I will scale on the way up. So when a stock is making multiples of the amount that I've risked, I'll take a little bit off the table here, I'll take a little bit off the table there, I'll take a little bit more over here. And so, for example, if I risk 5% on a particular trade, right? So if I enter at $100 a share and my stop loss is at 95, when it's hitting 110, then I'm taking a little bit off. It could be anything from, say, 10% to as much as 30 or even 50%, depending on what the price action has been, how long it took to get there, what the overall market environment is. But I always like to begin scaling out of positions on the way up. Then when it hits 4 times my risk, I'll take a little bit more off, 6 times, and so on and so forth. And I'm also looking at other kinds of defensive selling signals well, but the bottom line is that it's very rarely an all or nothing decision. So that way I'm able to take a little bit off here and be able to participate in the future upside. And I'm able to take a little bit off over here. And if the stock comes back in, then I didn't lose all of that. So that's a good way to also, again, preserve both your physical capital as well as your mental capital, which is even more important. Tip number 3, use bracketed stops. So, well, what's bracketed stops? Bracketed stops means that they're very similar to how we would scale out of positions at different points as it goes up. So stocks will form different support levels on different time frames. And so you don't need to have your entire trade be exited at this level. You could have, say, half of your position be exited over here and the other half down here, or you could break it up into thirds, or however you want to do it. You could set bracketed stops, so that way if your stock is at 100 and let's say it runs to 110 and then it starts to pull in, you could put a stop in at 105, then 102, at 100, or really wherever you want to put it. So that way, as it's pulling back in, you're selling bits and pieces, and it's, again, not an all or nothing decision. So that way and in doing this, you're really letting the market tell you whether you are right or wrong, and how right or wrong are you going to be. Think of it like if you watch poker, if you ever watch the World Series of Poker, and if you want to, as the probabilities start to become more in your favor or less in your favor, if you're able to take money out of what you initially risked, how good would that be? In the market, you can. If you see that your hand is starting to get worse, and that being the price coming back in, because if it's coming back in and breaking different support levels, then that's starting to tell you that what you had originally thought when you bought it could be wrong. But it's not all the way wrong until it hits down here. So to protect yourself, you could have these bracketed stops, and that way you are risking less and less, and you don't have to give up all the gains if you're selling out along the way. So bracketed stops is extremely, extremely useful, and it's something that I started to use. And it's something that, to give a quick shout out, to give Mark Minervini. Mark Minervini did a great presentation for the New York City Investors Business Daily meetup probably about 6 months ago at this point, and one of the big takeaways for me personally was his recommendation to use bracketed stops, and it's been fantastic. So, Mark, if you're watching, thank you so much. Really appreciate it. Tip number 4, timeframes matter. So when you mentioned that you had risked a little too much, or that you had made several thousand and you didn't want to give that up, well, what time frame were you trading on? Did you mean for this to be an intermediate term trade, or did you mean for it to be a shorter term swing trade? That's going to be very important too. And one of the things that I do too is for the portfolio that I'm managing, I make sure that it only has one time frame in it. So if this is going to be a swing trading account, then it's a swing trading account. I'm not going for intermediate term trades. I'm not going for long-term trades in that account. For my intermediate term account, I'm not taking these shorter term trades because it doesn't fit into the strategy of this portfolio. And being able to segregate the different strategies, that's something that's helped me out tremendously to not get confused, and to, if something is having a decent run in the intermediate term account, then I know that in order to get those much larger gains, that I will have to sit through some 15-20% corrections potentially. And so I'm a lot more comfortable doing that in this account that's set up for that, versus seeing that happen in my short-term swing trading account, where it's meant to get those singles and doubles and those quicker trades, where if I'm up, say, 20%, I'm not going to wait for the stock to come in and start correcting. I'm already probably scaled out of most of my position at that point. And yeah, that's the way that I've been able to effectively manage both a shorter term swing trading account and also have these other strategies that I'm running as well. One strategy per account, one time frame per account. Tip number 5, our 3-strike selling rule. Now, this is one that Adam Sarhan came and gave at a presentation to the New York City Investors Business Daily meetup late last year. And it's a video that I did on this YouTube channel and went into depth on it. But to briefly recap, what the 3-strike rule is that on the intermediate time frame, and you could really do this on any time frame, but the one that we're looking at is more intermediate term. You would look for a support level, you would look for trend lines, and you would also look at moving averages, primarily the 50-day moving average or the 10-week line if you're looking at weekly charts. And if price breaks all 3 of those, then that's when you call quits. And the reason why we're looking at this 3-strike rule is so that way when you don't get shaken out too quickly. That's number 1. But number 2 is that it's lining up different factors. So there's so many participants in the market, and all these participants are looking at different things, especially if they're looking at technicals. I mean, like, people could sell for any number of reasons, but if people are looking at charts, a stock could be getting support at a moving average. Then it could start getting support at a trend line. Then it could start getting support at various levels of support. And if a stock breaks all 3 of those, then what's there to prevent it from keep on falling? So that's the idea. That's the main idea behind that 3-strike rule. So tip number 5 is follow the 3-strike rule. Tip number 6. You have to be extremely comfortable with the amount of risk that you take on any trade, and also within your account, especially when your dreams are involved. Like if you are investing to buy a house, to save for your kid's college, or to save for a wedding, or any of these major life events, it's real easy to be more disciplined when you're first starting out, because you're starting out small. And as you begin to get closer and closer to that goal, and that goal becomes more imminent, both in time and with the amount of dollars that you need to achieve it, then that's when a lot of emotions can start to come into play. So my recommendation, and my workaround for that would be to, when you're starting to get close monetarily to that goal, then start to take some of it out and stop playing with it, because then, because the fear is that I'm getting close, uh-oh, I might lose that. Okay, so take that money, put it into the savings account so that way it can't be lost. And then now you're trading back with the original amount that you started, or maybe you're trading with a little bit more. And then you don't have that fear around this amount, because you've already taken the bulk of it that you need for your dream out, and that's nice and safe. And then you could keep on playing that way. Yes, the downside of that is you don't have the full sum to continue going, but what's more important than the physical capital is your mental capital. And that's the best way to end up preserving both. We need, in order to win in the stock market, and this goes back to our strategy that we're following in Advanced Stock Reports, and that Adam Sarhan taught to me with his investing methodology, DAMP. that name is ridiculous, but the first part of DAMP is defense first. And so in order to compound gains, and the way to win in the stock market is to continuously compound our gains. And the only way that we could really compound our gains is by putting defense first. So if we have a 10% drawdown, it takes 11% to get back to even. By the time if we were to have, say, a 50% drawdown in our account, it takes 100% to get back to even. So losses work exponentially against us. So if we are keeping defense in mind first, then it makes compounding so much easier. Just to talk about DAMP for a second, since I brought it up. DAMP is defense first, then looking for advanced entry points, then looking for the overall health of the market, so market health. And then the P is for psychological analysis. And we have a whole video about DAMP. I'll link that somewhere up here as well, and you can check that out too. Tip number 7, you need to split your account. If you are running multiple strategies, the way that it worked for me, and I mentioned this earlier, is that you really need to split your accounts if you're running 2 different strategies. So I would get into trouble all the time when I had everything in just one account, and I was trading intermediate term, and then I saw a shorter term swing trade idea come up, and then, I want to go for that one, but I don't have the resources in this account, so maybe I sell a little bit of this longer term trade, maybe I sell the whole trade, hasn't really gone anywhere yet, and then I go for the swing trade idea. Then the swing trade idea ends up losing. And then the longer term idea that was okay, didn't really run too far yet, but it was just kind of sitting there, then it decides to take off without me. How many times has that happened? So after dealing with that kind of nonsense for years, eventually occurred to me that, okay, I need to break up my accounts. And so now I have a swing term account, I have an intermediate term account, and I have a long-term retirement account. And each of those are traded slightly differently. The swing trading ideas, they're all my own ideas. I am managing that fully on my own. Then the intermediate term account, I'm actually following the model portfolio in the advanced stock report service trade for trade. So whatever Adam Sarhan does with the model portfolio, I buy that and I just follow along with it. And we just started a whole new series about our path to tripling the S&P 500 in 2017, because those are the results that I had by following the model portfolio, trade for trade, and just doing that. And so for anybody watching that's interested, you can take advantage of the Advanced Stock Report service, test it out for 3 months for only $27. Just use coupon code 3427. I'll put that up right here, and check it out. It's a fantastic service, and it's something that helped me triple the returns of the S&P 500 last year. Finally, for my longer-term retirement account, for that one, all of my funds in that account, they all basically follow the S&P 500 to one degree or another. So the idea for that one is to just stay long in those funds, and then once the S&P 500 starts to roll over and break below and close below the 12-month moving average, so I'm only looking at and managing that account once a month, then I'll exit. So we've been above the 12-month moving average for a very long time now, so I haven't needed to touch that retirement account at all. Once it finally does roll over and break below that 12-month moving average, that's when I will take it and move it into money market and just simply wait until it gets back up. Yes, it's possible to get chopped up a little bit doing that kind of a strategy, but you end up missing the 2000 crash. You end up missing all of 2007. And so by doing that, you end up coming out ahead dramatically. So that's the idea that I'm using for my retirement accounts. So again, if you haven't checked out the Advanced Stock Report service, you really should. It's only $27 for 3 whole months. Normally, this goes for $97 a month, but we realized that just testing it out for 1 month isn't good enough. You really need to check out the service for 3 months, so that way you could see how the model portfolio performs to different scenarios and over time, and get the full effect. So there's so much that the Advanced Stock Report service does. It also gives you direct access to Adam Sarhan as well as myself, and we get to act as your trading coaches every step of the way. In 2017, we were able to triple the returns of the S&P 500. In 2016, we doubled the returns of the S&P 500. Hopefully 2018 is an even better year. I'm confident that it will be. Every year we're getting stronger, we're learning more. And so come along for the ride, 3427, and let us help you out. Thank you all so much for watching. I truly, truly appreciate it. If you have any questions at all, please leave them in the comment section below, and I will personally help you. Also, if you like the video, click that little thumbs up button. That really helps us out a lot. And also make sure that you subscribe to the channel so that way you're going to get all of our updates. Thanks again for watching, and I'll see you again in the next video. Take care, and have a great day.